Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Recession shock. Bank of America is the latest major institution to deliver a grim warning for the future. I think talk of a looming recession is coming out all around us. We're seeing rising interest rates. February, it was at 7.9. March, it's already up to around 8.5. Yeah. We're seeing these types of things continuing to climb. And I think that when we talk about a recession, when we talk about these kinds of concerns, different fears that people are having, I think one area that you may want to focus in on is really around how you're creating your retirement income streams. So where is your income coming through? How are we producing these streams throughout retirement? And there's a couple different approaches that you can take towards that. And one of the first approaches that you can take is what's called the total return approach to retirement income. Now, this is something that a lot of people are doing already, whether they realize it or not. And what this basically means is you're in kind of an accumulation phase. You're younger. You're adding into your assets. You're being more aggressive. You're just really pumping money in. You're trying to watch it grow. You're saying, I'm 25 years to retirement, not concerned about it. But then you get into more of this kind of pre-retirement phase. You say, okay, I'm 2 to 3 years out from retirement. I'm getting closer. I need to start getting more conservative. And as that date gets closer and closer, you keep pulling back on your risk until eventually you end up in a retirement phase. And when you're in that retirement phase, what people tend to do is be very conservative and leaning much more heavily towards income-producing accounts, more income streams, not a whole lot of growth. They're really focused on that preservation and just slowly allowing that count to kind of ease its way on down. Mm-hmm. But that may not be the only approach. There is another approach, and it's called the buckets method, correct?
Right.
So talk us through that, Michael. How does that work?
Yeah, that's right, Matt. The bucket approach is similar to the total income approach. Okay. But it's really kind of segregating your assets into different buckets. And think of the buckets as different time frames of when you're going to need the money. So the first bucket is just that safety bucket. So something that's going to be liquid and more conservative, not very volatile, that you might need in the next, say, 2 to 3 years from now. The next bucket would be something more like a 3 to 7 year time frame. So this is where you would have more of the income focused investments, things like dividend paying stocks, and we'll talk about that later, some of the different income options for that. And then for longer term money, beyond 7 years, that's where you want the money to continue to grow. Yes, it's going to be more volatile, but you need that growth to help offset things like inflation and things that are going on in today's market.
So the idea being you've got maybe one chunk of money, but you split it into multiple different buckets, and so you view those funds and the risk associated with those funds a little bit differently.
Exactly.
So instead of having all of your IRA funds in one concentrated area, you maybe have it split across.
Correct.
Well, when it comes to that income bucket, I think people have a tendency to tie into one strategy or one particular type. And so I thought it'd be maybe kind of nice for us to rattle back and forth some different ways you can produce income. So right off the bat, first thing that comes to mind, not great right now, but it was in the past, CDs. CDs are an option. What else can we do?
You can also look at very traditional bonds.
Okay. Yep. Dividend.
Again, not a great option right now.
I was going to say bonds, interest rates are climbing, not the best place to be, but at the same time, it's something to consider. If you hold a laddered bond portfolio, that could work for you, right? Dividend paying stocks, which is something that you'd mentioned earlier. Dividend paying stocks, I think that's a great alternative at the moment, something to explore if you can handle the ups and downs of that stock price, kind of appreciating, depreciating, kind of moving with the market. You're having those stable dividends come in. What are some other ways?
Right. Some other ways are things like REITs.
Okay.
Real estate investment trusts.
Yeah, so real estate investment trusts, there's open-ended and closed-ended, right? It's a good way of investing in real estate without having to own physical property yourself,
Right. Right.
And then you could also do something like an annuity. An annuity could have income-producing streams. There's another option for you. What are some other ways?
Another option is like a managed payout fund. There's funds that are specifically targeted for people in retirement to get a certain maybe income stream over every year in their account.
Yeah. Or you could even do structured notes. Structured notes are another viable option. Now, I think the key takeaway from this, across the board, if you're concerned about recession, if you're worried about these types of things, I think it's well worth looking at your plan and saying, do I have these distinct buckets? Have I lumped everything into one distinct way of producing funds? Am I taking the appropriate amount of risk? But then also, do I have one income stream or do I have multiple income streams? How am I going to produce those funds? And I think the key takeaway here is not that there's one size fits all approach. It's not that there's only one way to do it, but you need to know how you're going to do it. And that's where having that detailed plan is going to come into play. I hope this has been beneficial. For Michael Sellers, I'm Matt Landon. We hope you have a wonderful afternoon.